heard of Dow before, but I have to confess I don't really know anything about it.
Charles Dow is the Dow in the Dow Jones Industrial Average, the headline US index containing 30 large blue-chip American companies. When spread betting or CFD trading, the market is called the Wall Street 30. This is probably where you've heard the term.
Yes, that's it.
There is a good reason the index is named after him. He came up with it. Dow theory was developed by Charles Dow and was later refined by William Hamilton. It seeks to explain trends and how they typically behave. We are going to go through the basics of Dow theory. Hopefully, you'll start to see the wider themes of it running through technical analysis.
So what is it exactly?
The theory has two core assumptions. The first is that averages discount everything. This means indices assume all information is factored into the market. Indices are commonplace now. Most traders can log on to their trading accounts and see an index in the popular market section. But a century ago, they weren't. It was pretty much only shares and bonds. Dow was a key advocate of using indices, and he created the Dow Jones Industrial Average to assist his analysis of individual shares.
Isn't that similar to the assumption in technical analysis that all information is discounted in a market's price?
Yes, broadly, Dow theory is one of the key influences in the evolution of technical analysis. Second, Dow assumes the main long-term trend cannot be manipulated by individuals. What this means is large participants can perhaps influence a price in the short term, but the collective will of the market will ultimately prevail. This basically means a market must be freely traded if we are to use Dow theory to help analyze it.
Okay, I think I'm with you so far. Averages discount everything and participants can't manipulate the trend.
From their work, several fundamental features of Dow emerge. Let's spend some time going through these. The first feature is the market has three movements: the primary trend, the secondary trend, and daily fluctuations.
In the lesson on trends, you said that there are three trends: secular, primary, and secondary. Are we talking about the last two here?
Yes, Dow didn't split out the secular trend, which lasts longer than 5 years. The focus in Dow theory is on confirming the direction of the primary trend.
The primary trend can last a year or two, can't it?
The general definition is a few months up to 5 years. But yes, you are on the right track. Once the primary trend has been identified, it will remain in effect until proved otherwise. Through a set of guidelines, Dow theory enables investors to identify the primary trend and invest accordingly. When investing, Hamilton and Dow were mainly interested in catching the big moves of the primary trend. Success is measured by the ability to identify the primary trend and stay with it.
What are the guidelines?
Let's look at an example on a chart to show you. So Hamilton and Dow said the first step in identifying the primary trend for individual US shares is to identify the trends of the Dow Jones Industrial Average and Dow Jones Transportation Average.
Okay, and how do we do this then?
Let's do it for the former. It would be the same process for both. We simply do this by using the trend line or moving average analysis we introduced you to in an earlier module. If we look at our chart, we can see the price is above all three moving averages. So Dow would have said the average was trending up based on this evidence.
I have a question. Why do they refer to the transportation index?
Well, when Dow theory was being developed before the turn of the last century, the railroads were a vital link in America's economy, and shares in these businesses were bundled together in the transportation index. Hamilton argued that activity would begin in the transportation average before the industrial average. He attributed this to the fact that before economic activity began, raw materials would have to be moved from the suppliers to the manufacturers.
Right. So a general increase in prices in railway shares was thought to be an indicator of a strong economy?
Yes, in addition to trading in the direction of the primary trend, Hamilton and Dow stressed that for a buy or sell signal to be valid in a stock contained within the wider market, both the industrial average and the transportation average must confirm each other. For example, if one average records a new high or new low, then the other must soon follow for the primary trend to remain valid. So that was the primary movement. Now let's look at the secondary movement.
A secondary trend is shorter than a primary trend, isn't it? That's a few weeks to a couple of months.
Yes, the secondary movement or trend runs counter to the primary trend and it's shorter and reactionary in nature. In a bull market, a secondary move is considered a correction. In a bear market, secondary moves are sometimes called rallies.
Okay. Can you provide us with an example that shows the secondary movement in action?
Okay, let's look at a daily chart of euro-dollar. I've marked it up with the primary trend, which is bullish, and the correction would likely be described as a secondary movement by Hamilton. He also noted that secondary moves tend to be faster and sharper than the preceding primary move, which it is in this case.
Okay, I'm following.
So Hamilton characterized secondary moves as a necessary phenomenon to combat excessive speculation. Corrections and counter moves kept speculators in check. Because of their complexity and deceptive nature, secondary movements require extra careful study and analysis. Investors often mistake a secondary move for the beginning of a new primary trend. Let's look at daily fluctuations now. Hamilton and Dow viewed daily fluctuations, while important when viewed as a group, are dangerous and unreliable individually. Due to the randomness of the movements from day to day, the forecasting value of daily fluctuations was considered limited at best.
So Dow disregarded daily fluctuations.
Well, remember, this is from an era before the trading we know today, and the technology needed to do it properly was invented. That's when a day was a short period of time. The point to take away from this is getting too caught up in the movement of just a handful of short time periods can lead to hasty decisions that are based on emotion. This is true if an intraday trader is looking at a few ticks worth of data as much as it is a long-term investor looking at daily changes.
So it's important to keep the whole picture in mind when analysing individual price movements.
Another feature of Dow theory came when Hamilton identified 3 stages he believed primary bull and bear markets each go through. These stages relate as much to the psychological state of the market participants as to the movement of prices.
So within a primary move, the market goes through different phases. What are they?
Stage 1 is called accumulation, stage 2 is called the big move, and stage 3 is excess. Then the primary moves of a bear market mirror these. From the excess stage, it moves into distribution, then the big move down, followed by despair. Eventually, it will return to accumulation and the process starts again.
And what's going on in these stages?
Dow's 3 stages of bull and bear markets is the foundation of the final theory we're going to introduce at the end of the lesson, called the 4 market stages. Instead of repeating myself, I am going to go through each stage in detail there. For the time being, you just need to know that Hamilton recognized primary trends, move in stages. In the Dow theory, which is focused around share analysis, volume is important when confirming the strength of advances and can also help to identify potential reversals. Hamilton taught that volume should increase in the direction of the primary trend. In a primary bull market, volume should be heavier on advances than during corrections. Not only should volume decline on corrections, but participation should also decrease. This is when both bulls and bears become undecided.
Okay, and what about in a primary bear market?
In a primary bear market, volume should increase on the declines and decrease during the reaction rallies. By analyzing the reaction rallies and corrections, Dow theory says it is possible to judge the underlying strength of the primary trend.
That's really useful. I can see what you mean by it being a theory. It helps explain the broad changes in the market. But does it work? Does it explain how the market works?
There are definitely bits we can take from it that are useful, but as a whole it has weaknesses. Let's look at those now. Dow theory is criticized for being too late. With Dow's guidelines, the trend does not change from bearish to bullish until the previous reaction high has been surpassed.
And so traders can miss the move.
Exactly, it's a bit like a lagging indicator in that regard. Traders can wait too long to confirm the trend and by doing so, miss it.
Yes, I see how that could be problematic.
Because it uses the transportation index and requires that to be aligned with main index, Dow theory is criticized as being outdated and no longer an accurate reflection of the economy. Even as the old railway stocks have been replaced by airlines, the logic that goods need to be transported before economic activity takes place is outdated.
Yes, I see your point. I can think of lots of service businesses where this wouldn't apply.
While some aspects of Dow theory are transferable to trading, it's mainly written with equity investing in mind. For example, volume plays a big role, which is easily accessible from the exchange when trading A shares, but difficult to accurately measure when trading OTC markets like FX.
So, if we can't analyse volume, the theory loses some of its usefulness.
The final weakness in the theory concentrates on the primary trend and effectively ignores daily fluctuations. Trading has moved on, and today's traders need to understand how to interpret the market in shorter timeframes.
Thanks for this run through. I'm clear on all of those. What is worth taking from Dow theory?
Despite its limitations, there are a few important elements traders can take from Dow theory.
What are those?
One of the real takeaways is to always have an appreciation of the primary trend. Knowing the direction of the primary trend should provide context to every trading decision, no matter what time frame is being traded.
So if the primary trend is up, traders typically favour going long.
It's not just in the security you might be trading, but Dow theory teaches traders to have an appreciation of the general direction of the wider market. For example, if the FTSE 100 is trending up, then going short on an individual share in the index needs careful consideration. Finally, I do subscribe to the theory the market goes through various psychological stages. We'll look at how this concept was taken and developed when we move on to the 4 market stages.